In this screencast, we're going to start looking at the Bob's Instant Coffee Cart Case, Part 2. The focus in Part 2 is going to be on journal entries, T accounts, and the use of the T accounts to update the balance sheet. On this screen, you can see the case study for BICC Part 2, and you can also see the opening balance sheet at the beginning of the month. As before, read over the case, journalize the transactions, and then prepare the financial statements. We've seen this transaction before, where Bob rents the instant coffee cart in advance and then recognizes the expense at the end of the month. So at the start of the month, an asset is created called prepaid rent, and you can see the asset being represented by the prepaid rent T account. A credit is made to cash, and so the accounts remain in balance because we have two assets, one that is increased, prepaid rent, and one that is decreased, cash. At the end of the month, the expense is accrued, and as you can see, there's a debit to rent expense, and this will be on the income summary account. There is a credit to prepaid rent, the asset. Credit will reduce the balance in the prepaid rent account. Let's look at the effects on the balance sheet of these two journal entries. So we see the balance sheet at the beginning of the period before either of those transactions are recorded. When the prepaid rent account is set up, you can see that there's a asset, prepaid rent created, and a reduction in cash, and you can see that in the individual T accounts. Then, when the second journal entry is made at the end of the month, there's a debit to rent expense and a credit to prepaid rent. And once again, notice that the prepaid rent T account, here's that credit, so the balance goes to zero. And then you can see that zero balance on the balance sheet. There's also a debit to rent expense, which would be on the income summary. On this slide, we're going to emphasize another transaction that we've already covered in a prior video, and that is the purchase of inventory. Here, inventory is purchased for $2,600. $1,800 is paid in cash, and the remainder is due in the next month. We journalize the transaction with a debit to inventory, $2,600, credit to cash, and credit to accounts payable to recognize the amount that will be paid later. We can then look at the inventory T account, where we start with the beginning balance, add the purchases, and as you can see, $2,950 is the current balance in the account. Let's look at how this transaction affects the balance sheet. We'll start off with the balance sheet before the transaction. Then we will record the transaction, in which case you can see the adjustments to both the inventory T account and to the cash account. And then we can prepare a revised balance sheet. Notice how the balance sheet has changed. There's been a reduction in cash from $4,950 to $3,150, an increase in inventory, and an increase in accounts payable. In this transaction, Bob collects $250 of the $300 of accounts receivable created in the last month. Bob also determines that the remaining $50 is not going to be collected. We journalize these transactions, first of all, by the collection of cash, debit to cash $250, credit to accounts receivable, and then we write off the uncollectible account by debiting bad debt expense and then reducing accounts receivable by the amount of the account that's not going to be collected. This is sometimes called the direct write-off method and is not really the method preferred by GAAP. So to keep track of things, we look at the account receivable T account, and you see that we started with the debit balance of $300, and then when $250 was collected, that means those accounts are no longer owed to us, so that's a reduction in accounts receivable. And then you can see the write-off of the bad debt. Now let's turn to the impact of this transaction on the balance sheet. We have the journal entry and the T account. Let's also keep track of the impact of the cash collection on the cash T account. We're now in a position to prepare an updated balance sheet. And as you can see, the cash balance is now $3,400. Accounts receivable has a balance of 0. And notice that when we debited bad debt expense, we reduced retained earnings to $950 from $1,000. We now have another transaction related to revenues. We dealt with this type of transaction during the first month of operations, and so we can follow the similar pattern. Total revenues $4,800, 90% collected in cash, 10% are accounts receivable and are outstanding at the end of the month. The journal entry here is a debit to cash for 90% of the total revenues, $4,320. Accounts receivable get debited for $480, and the credit to sales revenue, $4,800. Let's update the accounts receivable T account. Once again, let's just review what happened. $300 is the balance in the account at the beginning of the period. $250 were collected during the month. An account for $50 was written off. And then in this transaction, we have new accounts for $480. We can then see how this would impact on the balance sheet, as the balance now goes to $480. Also notice that we've had an increase in retained earnings of up to $5,750, and this reflects the sales revenue. And we've had an increase in cash of $4,320, reflecting the amount of cash collected. And once again, everything stays in balance. In month 2, Bob pays $400 in wage expense. Well, actually, I should say not that he pays $400, but that he accrued $400 of wages. It turned out that $325 were paid in cash, and $75 were still owed to employees at the end of the month. This is a fairly straightforward transaction, so I won't take too much time going over it. Starting with the journal entry that we looked at on the last slide, we now can compare the balance sheet before the journal entry and the balance sheet after the journal entry. So notice the wage expense, we would expect that to decrease retained earnings, and we see that $5,750 reduced by $400 to $5,350. Cash reduced by $325. $77.20 down to $73.95, and the establishment of a wage payable, which is a current liability, and we go from 0 to a balance of $75. If you understood what we went over in this part of the video, then I encourage you to take a look at some of the following variations just to check your knowledge and understanding. This will end Part 2 of BICC case, video 1 of 2. We still have a few more things to cover, and we'll get to those in the next video.